Che cosa At this point, we shall go to the other shore of the ocean. We will now have Charles Piszczor, who is Director of Research and Commodity Development of CME. I'm sorry if I mispronounced your name. It's not easy to pronounce your name. You are a usual guest here. This is the third time that you come to this forum. Thank you very much for being here with us.
Good afternoon, and I'd like to thank CLAL for providing CME the opportunity to speak at this year's Dairy Forum again. So let's jump into this. What we're going to talk about today will be spot contracts, futures contracts, and options contracts offered at CME Group. Then we'll look at the CME Dairy Markets and what we offer. And then wrapping up, we'll have a comparison of the various futures markets available globally. Let's talk about the spot contracts at CME. We offer 3 contracts at the CME for the spot market. We offer a cheese contract, a butter contract, and a non-fat dry milk contract. These contracts have some similarities as far as the contract specifications. By that I mean when you have the cheese contract, you will have a weight range that you can deliver between 40 and 44,000 pounds of cheddar cheese. You can either deliver a block, which is in a 40-pound size, and you have a barrel that you can deliver. That is in a steel barrel or a corrugated fiber barrel. And these contract specifications are laid out so that you know that what you have to bring to the market to sell, and as a buyer, you know what you will be receiving when you come to the spot market. It will always be the same. You will know that the cheese has to meet certain requirements. It'll have to have a certain moisture content. And if it doesn't, then there will be a discount that applies to that load that you buy. It will also have a grade that it has to meet. For butter, let's say it is a grade AA specification. Non-fat dry milk, it has to meet certain specifications or grades. It has to be grade A non-fat dry milk. And every time you buy or sell, you will know that that's what you will be receiving and in what type of packaging that it will be coming in. You will know that it will be coming in on pallets when it's delivered, when you take delivery of that, or when you're delivering it on the exchange. You will know certain requirements for documentations that need to be with that product when you buy or sell it. You will know that it'll need a grading certificate if it's butter, a USDA double grade AA butter certificate issued by the U.S. government. On the non-fat dry milk, you'll need a certificate of analysis outlining what are the specs of that product. As a buyer, you will know that you have the option, either on the cheese, on the butter, or the non-fat dry milk, that you can have that product graded again, even though it's coming with a grading certificate or a certificate of analysis. It is your option to have that product graded again or inspected so you know that that's what you're receiving. That's your option, and then you'll have to pay for that grading or inspection of product. If that product fails, the seller will have to replace that load to you within 3 business days. They will have to have product available so that you can go in and pick up that product. You will also have to send in to our clearinghouse various forms, the buyer's identification, the seller's identification, the day after the sale, so that they can get matched up, so the invoices can be issued, and so that payment can be transmitted back and forth between buyer and seller. The spot market is for immediate payment and transfer. So when you buy a load of any of the 3 products, butter, cheese, non-fat dry milk, that product has to be available for pickup within 7 business days. The seller has to make that available within that time frame. If they're not, there is a fine that the exchange imposes on the seller. There's a fine if the buyer does not pick up that product in time from the manufacturing plant or from the warehouse. At the CME, we want to make sure this product moves back and forth efficiently and quickly as possible, because that's what the spot market's for. The market is designed for small quantities, meaning the spot market at the CME is not a procurement contract for your business. It's for short-term needs only. By that I mean, let's say you are a butter manufacturer and you have contracted with a large grocery store chain, and you're running into the summer months. Normally the summer months, milk production decreases. That means fat content in the milk usually goes down as well. So now as you as a manufacturer are running low on cream to turn that into butter, you go to the spot market and you would buy a load of butter to meet your needs for your end consumer that you have sold butter to for on a, let's say, a year contract to that grocery store chain. Again, it's for adjusting inventories. If I'm a manufacturer and I find out that I'm producing too much cheese, butter, non-fat dry milk, and I have to dispose of that, I can go to the CME spot market and dispose of that 5 days a week, 260 trading days a year. I can move that product if I have to, or I can buy that product if I have to. Let's talk about futures contracts. It's a standardized contract specification. Again, let's use our milk contract. You will know that it's for 200,000 pounds of milk, or roughly 90 metric tons. You know that the contract has daily price limits. Daily price limits are the amount that the price can move within the trading session that day. For example, let's say, hypothetically, milk is trading at $1. The milk contract has 75-cent limits. So that means that during the trading session, the milk can go up to $1.75, or it can trade down to 25 cents. So that's, you know that that's your daily trading range for that milk. That, you know that that's as high as that price can go that day and as low as it can go that day. The following day, if the market settles at $1.75, then again you have another 75 cents up, another 75 cents down during that trading session. So when you will also know how that contract settles. We settle at the CME to a United States Department of Agricultural, AMS, Ag Marketing Service number every month. The USDA, they survey large manufacturers of butter, cheese, etc., and powder. They do that every week. They take those, it's a weighted volume price. They take that throughout the month, and at the end of the month, that's what we settle our contracts to, be it the cheese, the whey contract, the non-fat dry milk contract, butter contract, and the Class 3 and Class 4. So now that you know that these contracts have these specifications and they're all standardized, what does that mean for you? Well, that allows for contract offset. What do I mean by contract offset? That means if you go into the market today and you buy a futures contract and you hold that contract, let's say for a minute, 2 minutes, a day, a week, a month, 6 months, 8 months, a year, 2 years, you can go back into the market at any time and sell that contract back with anyone in the market. You don't have to go back to the same person you bought that contract from. That's why it allows for easy contract offset. It can be done with anyone who's trading in that market. The only thing that's not standardized in a futures contract is the price, and the market determines that price. As Angelo showed in his presentation, as Mr. Thiel showed in his presentation, supply and demand. climate. Market conditions can change at any moment. That can cause prices to fluctuate within a futures market. And what's happening is all this information is coming into a centralized trading floor or trading arena. It's your information where you're thinking prices should be next week, 6 months out, 8 months out, a year out. You're looking at information as, well, what's the weather forecast? You know, what are they predicting for 6 months out? Am I coming into the summer months? Are they predicting a drought? There's a drought in California. What's causing milk prices? You're having a decrease, in production of milk prices because of that. In production. So what does that do? That drives up your input for producing butter, producing powder, producing whey, cheese. So all this information is coming into the market and deriving that price. In a futures contract, you have two choices when a contract is written. It can either be physically delivered, meaning you actually take that product, if it's for, let's say, cheese, and it's for cheddar cheese, you will be taking cheddar cheese for delivery, or if it's butter. But at the CME, all of our contracts are cash settled. We've had physically delivered contracts in the past. The market has spoken, and they prefer a cash settled contract, meaning that at the end of the month, or at the end of that contract term, and you're still holding that contract, you will receive a payment, or you will make a payment, depending on what position you have put on with that futures contract. So you are obligated with a futures contract to deliver product or make that payment. Contract functions. They function as risk management. What are you managing? Your price. You're managing your margins as a business. You're locking in a price. Dr. Thiel showed one of his last slides where he was showing the ups and downs, and then he showed a stable milk price. That's what you're doing with futures and options. You're stabilizing that price. As the market's going up and down, and you've used futures and options to set a strategy for X amount of time, you are managing your company's profits or margins throughout that time frame. And again, it's also for price discovery. It's helping the market decide what the value is of that product by all that information coming in from buyers, sellers, and liquidity providers / speculators. They're coming into the market and they're helping determine a price for that product. Financial integrity. When you trade futures and options, you will, depending on what you're buying, let's stick with dairy, you will receive a cash payment no matter what at the end of that contract period if you're still holding that contract. You're guaranteed to receive payment. In other contracts that are physically delivered, you're guaranteed, like our corn contract, you will be receiving corn. Even if the other side that you bought that contract from collapses, doesn't show up, the CME's clearinghouse is backing that trade. So you will receive your payment guaranteed. You will receive that product guaranteed. That's the CME clearinghouse standing behind every trade. And that's just not for dairy, that's for all of our products, all of our agriculture, all of our energy products, all of our financial products. You will receive your payment or your delivery of product. Let's talk a little bit about options on futures and what they are. They're rights but not obligations. Futures contract, when you buy or sell, you are obligated to make that final payment when the contract settles. You will receive that product when the contract settles. But on the option side, it's the right but not the obligation, meaning as a call option, you're buying the rights to go into the futures market and receive a contract, either a buy-side or sell-side contract. Same thing with the put option. It's the right to sell a contract on the futures. Option positions. As an options buyer, you are receiving those rights. If you hold that option and it goes into the money, that's a term where you buy an option at a certain strike price, and if it goes past that strike price, then you can either, you have two options what to do with your option. That makes sense. You can either sell that option to someone because that option now has value, or you can take that option and exercise it into a futures position, and then take that futures position and receive product or receive the cash. It's all a strategy, and that's what you're doing because, again, you're managing your bottom line, you're managing your margins. As an option seller, you're providing those rights to the buyer. So if I sell someone an option and that option goes into the money, I'm obligated now to give that person those rights to go into the futures market and take the buy or sell side of that underlying futures contract. Options provide more flexibility for risk management. There are over 25 different strategies that you can use with options. Whereas a futures contract, it's either a buy or a sell. With options, you can buy a call, sell a call, buy a put, buy a call. There's all sorts of strategies that you can use, and you can tie those back in with the futures. So with a futures contract, you're kind of limited in what you can do. With options, you have many more tools in your toolbox to manage your risk. Let's talk a little bit about volume, some quick terminology that you hear all the time. Volume versus open interest. What is volume? Volume are the number of contracts traded. What do I mean by that? You go into the futures market, you buy a futures contract or sell a contract. You're holding that position. That's not volume because those contracts have not been offset yet. Once you offset a futures or options, meaning taking the other side of the position that you put on, that counts as volume. In 2014, we traded close to 1.8 million dairy futures contracts. Open interest. Number of contracts outstanding. Futures contracts, we have 100,000 dairy contracts open across all 6 products. Options, we have 128,000. So what does open interest mean? What is that telling me when I look at those numbers for open interest? Well, that's a measure of liquidity. What do I mean by liquidity? The more contracts you have outstanding, that means that you can go into the market and trade in or out of your position that much more efficiently and quickly at the price that you want to trade at. That's what open interest is. So the greater open interest, the more the markets are converging, the prices are coming closer together, the more liquidity, there's more people in the market, the faster you can enter and exit your position or strategy. Open interest does not apply to spot contracts because spot contracts are, again, for immediate delivery. So there's nothing outstanding. Those contracts have to be delivered. Quickly, let's look at some events in CME history. 1898, we started the spot butter market or cash market. Again, you'll see spot, cash, and physical. Those are the same terminology for the spot market. It's just a different way of saying it. At CME, 1919, launched butter futures. We had a cheese contract from 29 to 41. We introduced butter futures in 1996, followed by milk futures. It was deliverable at the time. Again, that wasn't an efficient way for the contract to work. Then we moved to cash settlement, which was a basic formula price, and these were the structures used in the U.S. for pricing. Then they changed to the class pricing structure that we've had since 2000. 1997, we reintroduced the cheese market, spot market. 1998, non-fat dry milk. And we continue to expand all of our dairy products. In 1999, we launched dry whey, and then in 2010, we had a cheese futures contract back in 1998, and we relaunched it back in 2010. Here are the products that we have at CME currently. On the left-hand side, futures and options for these 6 products, and our spot market products. Or here again, I'm using the term physical. Again, they're all interchangeable. All right, let's look at some other offerings now, globally. Euronext has skim milk powder, whey, butter, EEX, butter, whey, S&P. New Zealand has whole milk powder, skim milk powder, AMF, and butter. A little shout out here to GDT, even though it's an auction, it's not a futures contract, but tip of the hat. And over the counter, I want to touch on this briefly. Over the counter, specialized products. Let's say that someone wants to trade a whey protein concentrate, 30 or 84. There's no futures contract for that. But if I can go out in a dairy market and find someone who wants to do a contract with me and settle on the terms, the price, and all the other mechanics on how it wants to be delivered, or if it's cash settled, I can write a dairy contract as an OTC contract with that individual and use that as a hedging mechanism. One thing I want to point out with over-the-counter products, they are not guaranteed. They're only guaranteed by the strength of your counterparty. So if you go and you have a OTC contract with a counterparty, and that counterparty goes bankrupt 6, 7, 8 months into your contract, you have no recourse. There's no one backing up that trade, such as a futures trade where you have the CME backing that trade. It's only the good faith credit of that partner that you entered that contract with. An OTC contract can be even for a futures look-alike, but it could have a different settlement mechanism. So these are different types of products that are in the marketplace. But again, they're not guaranteed by anyone. Product comparison of the various markets. CME's products, settlement, USDA, AMS. We have 24 months listed. Contract sizes, butter and cheese, 9 metric tons. Dry whey and non-fat at 20 metric tons. And our milk contracts are at 90 metric tons. We offer futures and options on all of our products. Again, a broader toolbox to manage your risk with those options as well as using futures. 2014, again, 1.8 million dairy contracts we traded. NZX, they use the GDT price to settle their contracts. Again, cash settled. They list out for 18 months. Size of their contract, 1 metric ton. Futures and options, only on whole milk powder. Strictly futures on everything else. Their volume was 102 contracts. 102, yeah. Euronext, S&P, whey, butter. They've decided to go the deliverable route. So you will be receiving 6 metric tons if you hold that contract to expiration of S&P, whey, or butter. They list out 18 months. Again, futures only. I could not find any volume for them for 2014. EEX, they list butter, powder, and S&P. Again, they're using an index, cash settled. It's the Eurex index. They use the 3 locations that they settle their contract to. 18 months, 5 metric tons each, and they only offer futures on their products. Volume, 2,400 contracts in 2014. I had a mix-up in the slides. This is a whole other section. I'm way over time, so I'll have to skip through this. Sorry about that. So in conclusion, we talked about a spot market, what it is, contract specifications, they're standardized. Same thing with a futures and options contract. All those products are guaranteed by the exchange. Talked about a little bit about the CME history and a comparison of the various dairy products that are available globally. Thank you for your time, and here's my contact information. Little disclaimer that we add at the end. There you go.
Grazie a Charles Piszczor.
Well, thank you very much, Charles. A clarification, the minimum and maximum duration of the contracts. I thought I understood maximum duration 24 months. Is that right? And the minimum duration?
Poi lei ha detto ci sono 25 diverse.
And then you said that when it comes to options, you have 25 different strategies that you can use to manage risk. Can you give us some examples? Not all of 25, of course. Okay.
You could sell a put and you could buy a call. And what you'd be doing is you'd be locking in the maximum buy price for that product and then the minimum selling price. So that means that if the prices start going down, you've locked in at a price. And no matter how far it goes down, you've locked into that selling price. Now on the upside, you've locked in a price that you're buying at. And if that price continues to increase, you've locked in a price that you're only going to buy it at X amount of dollars. So no matter how much it goes up, you've already locked in a price that you're going to pay. So if you lock in a price of 25 on the upside and it goes to 28, you have your contract that says, I'm locked in at 20.25. So that's a simple strategy using options. And again, with options, I'll touch briefly. With futures, there's something called a margin call. So as prices move up and down throughout the day, CME marks the market twice a day, meaning that throughout that, I think it's once in the morning and in the afternoon, wherever that price is, they look at your position, and if you made money on that day, there's no margin call. If your position is losing, you have to call, your broker will give you a call and say you have to increase your margin account. It's called maintenance. So you'll have to pay up to a level that is established with your brokerage firm to maintain that margin account. And if you do start using futures and options and various strategies, again, that can help with managing those margin calls. So again, it's very complex, and we didn't have a whole lot of time, but I just wanted to give you a quick overview. Thank you.
Grazie.
Scusa. Thank you.
Volevo ringraziare il professor Thiele e Charles. Io lo chiamo così, Piszczor, perché
I wanted to thank Charles and Professor Thiele because I do appreciate the futures. I know they're very difficult, but we have to think about these contracts. I'd like to thank Charles, who's been coming here for 3 consecutive years. Also, Professor Thiele is a friend of CLAL, so we want to go on understanding these things and studying these things. Thank you very much. There is a question. Microphone, please. Microphone, please. We can't hear the question. And please switch the microphone on. I would like to know how many tons a year of milk powder and butter. I'd like to know whether there is an optimized system for only large companies, large producers, but also or for small producers? Is there an optimized system? I'm not sure who the question is. Charles, perhaps?
Che poi successivamente anche per Michael.
Or Charles, but also Michael Nolan thereafter, perhaps can answer the question.
I guess I have a question to get more clarification. When you say tons, are you talking about the futures contracts or are you talking about the spot market?
Future contracts.
Futures, okay. Actually, when you have it's not specifically for large companies. The contract size was made for everyone to participate. When we first started the dairy contracts, we offered 50,000 pounds and 100,000 pounds because we thought we were going to get the smaller producers to trade the contract, but they never participated. What we found is that in the U.S., you'll have your larger dairy producers trading the contract, or they'll be going through their dairy cooperatives to trade the product. So with the dairy cooperative, they'll aggregate from the smaller producers, and they'll put a position on in the futures contract with that, with the aggregated amount from their producers. Okay. Now, as far as the tons, I don't have that offhand. You'll be here. I can calculate that and get back to you on that. Okay. You're welcome.
Ce l'ha Tile? Tile ce l'ha.
Yes, if, for example, if you want to hedge, for example, fluid milk on the European future markets, because of these 5 tons is one contract, 5 tons of skim milk powder and 5 tons of butter is one contract. So behind 5 tons of butter and 5 tons of skim milk powder, you need 100 tons of raw milk to produce 5 tons of butter and roughly 9 tons of skim milk powder. So then if you want to hedge on the future market 100 tons of milk per month, then you need to, for example, to sell 1 contract of butter and 2 contracts of skim milk powder. That means in a year you need, just for these sort of calculations, you need 1.2 million kilograms per year as a milk producer. When you want to take part on the future market, and if you want to hedge 100% of your milk, that means you need to be a bigger milk producer, or you need to have a milk producer organization, or you need your companies, your processors. Yeah.
I'm sorry, Mr. Tile. You said as the quantity you traded in skim milk powder and in butter. We know.
Ora, noi sappiamo le quantità, ad esempio, del GTD, perché lì abbiamo le aste, ma non sappiamo che cosa avviene a Chicago. Parlando di latte liquido, grossi volumi, ma se parliamo di AMF, sono piccoli volumi in tonnellate. Now, Mr. Tile, during your presentation, you said, so you told us the quantities of butter and S&Ps which are traded at the Eurex. We know that because for each auction we have the data on volumes of butter and powders which are traded at the GDT. We would like to know the data for Chicago. How much butter is traded in Chicago? Because if we speak of money, if it's fluid milk, it's a huge quantity. If it's AMF, it's not so much, or quantity is not, volumes not so much.
Tea is not a futures market. That's a procurement market.
I know, I agree, but we know about how many tons are we talking about. We don't know in Chicago how many tons are we talking about in butter and skim milk powder.
Right. Okay, I'll calculate that and get back to you. Okay.
Thank you very much.
Io darei la parola a Michael Nolan,